Natural gas had another weekly green week. This makes four in a row, going back to June 5th. Now on the daily chart, exactly as predicted, I was expecting price to come down to retest what was a resistance support band before moving higher again. Now, why did prices close green again for last week? Um, let's get to some of the news because there was a lot of news out. This article is coming from fxstreet.com. Natural gas prices rebound strongly on a weaker U.S. dollar after inflation data misses. But natural gas prices are just not a domestic phenomenon. It is a global phenomenon, and we'll get into that. So on Friday, we had inflation data released by the U.S. and uh, prices fell, which weighed on the U.S. dollar. So if inflations are going down, that means that the Fed is doing their job, in which they don't need to raise rates higher. Um, less rates, that puts downward pressure on the price of the U.S. dollar, right? Because um, forex traders are looking for the highest returns on their for their money, so they're looking for economies that are having or that have the highest interest rates, and that's why you see the yen, which is trading um, downward against all other G7 currencies, including the U.S. All right, but also I mentioned it's natural gas prices a phenomenon, global phenomenon. In Europe, stockpiles are at 77% capacity. Now we'll get into what does this mean relative to previous years. Um, so European storage levels of natural gas built up in preparation for the winter are substantially higher than the previous years, easing supply concerns and putting a lid on prices. So putting a cap on prices, right? It's a supply demand situation. Capacity in Europe is now 77% according to the latest data from S&P Global, which compares to 58% in 2022 and the same year time in roughly 48% in 2021. Um, However, S&P Global's article suggests demand may rise again in Q3, but we're not going to see natural gas prices at $10 plus like we saw a year ago. Also, Europe is getting a little wiser. They know that they have to wean off of natural gas being supplied by Russia, so they are reducing their consumption of energy as much as possible. Um, we also have weather, Mother Nature. The 2022-23 winter was also relatively mild in both the U.S. and Europe, reducing demand for natural gas and leaving stockpiles high from last year. Um, Now, I was watching the situation in Russia a week ago, as I was anticipating that if things were going to escalate, we were going to see a huge surge in natural gas prices. However, that didn't happen. Natural gas has also fallen after the return of geopolitical stability to Russia, which is still a major producer. When the Wagner Mutiny began, prices rose on fears supply would be disrupted by a civil war. However, now that the mutiny is over, they have fallen back. So, what am I expecting um, for natural gas prices heading into this week? Well, um, we are still in the beginning of the summer. We're coming out of the shoulder season, which was a build in natural gas. So as summer progresses and temperatures continue to move higher, there's going to be a draw on natural gas, which should be bullish for natural gas prices. Nevertheless, demand for natural gas to power air conditioning may be about to moderate following reports that temperatures in the U.S. are set to return to average ranges for this time of the year next week. So we recently saw a heat wave in Texas where we saw triple-digit temperature, but things may have calmed down since then. Nevertheless, now when I look at the daily chart, I'm going to put a floor at the resistance support band at 260. I'm looking for a target, short-term target at $3, which is where we have the most recent pivot high. But my mid to longer term meaning fall time, is going to be this 350 level where there are weekly sellers waiting to push his price back down. Ideally, what I want to see is prices get to the $4 range, and if we scroll out to, if we stay on the weekly chart, um, that $4 level is based on the most recent highs and the lows going back to a year ago. The lows were roughly $2, the highs, say $10. So that only represents roughly 25% of the most recent highs going back to about a year ago. So that's very reasonable, right? If this is expensive, this is cheap, this is a little less cheap, right? $5 would be equilibrium. So below 5, you're in the cheaper half of gas prices. Above 5, you're starting to get expensive. So ideally, $4 is my target. I'm sure my call options that expire in 2025 probably are up another 5%. So I might be up 20 to 25% on my options that I bought back in May. May time frame, right about here. All right, so thanks for watching. Subscribe, please like the video.